Something is breaking in the silver market right now, and most investors still don't see it. Prices are moving, headlines are loud, and yet the real signal isn't on the screen. It's in the vaults. I want you to picture this for a moment. Demand is rising. Industrial consumption is accelerating. Central banks are still accumulating gold at historic rates, and at the same time, the physical metal that backs a portion of the silver market is quietly draining away. That combination has appeared only a handful of times in modern financial history, and every time it did, volatility followed. If you look closely, the signals are already fractured. You can see it in the widening gaps between physical premiums in Asia and quoted prices in Western paper markets. You can see it in backwardation appearing in silver contracts, an abnormal condition in a metal that usually trades in contango because storage and financing costs normally push future prices higher than spot. When the front month trades above future delivery, it is the market whispering that availability matters more than time. I have watched markets long enough to tell you that backwardation is rarely noise. It is usually stress surfacing through price mechanics. The real reason behind this tension is not speculation alone. Silver is not just a monetary metal. It is a critical industrial input. Solar installations, electrification, high-efficiency electronics, and advanced manufacturing have all been pulling physical ounces out of circulation year after year. Unlike gold, which is hoarded and rarely destroyed, much of the silver consumed in industrial processes is dispersed or uneconomical to recycle. That means each deficit compounds the next. Over the past decade, structural supply gaps have become more frequent, and the inventories that once buffered the market have been steadily eroded. And this is not an isolated phenomenon. Around the world, governments are running persistent fiscal deficits, global debt levels have reached historic highs, and central banks, despite tightening cycles in recent years, have struggled to push real yields decisively higher. Liquidity has not disappeared, it has simply shifted channels. In environments like this, tangible assets tend to regain relevance, not because of fear alone, but because trust in long-term currency stability becomes less certain. We have seen similar dynamics in the late 1970s and again in the aftermath of the 2008 financial crisis, when metals moved not gradually, but in violent repricings. Yet, here is the contradiction that confuses many observers. Equity markets remain resilient. Inflation, while still above long-term targets in many economies, is no longer accelerating at the pace seen a few years ago. Central banks speak cautiously rather than urgently. On the surface, this does not look like the kind of environment that produces supply stress in commodities, and that is exactly why the signal is being missed. Markets do not break when everyone expects them to. They fracture when stability appears convincing enough to reduce vigilance. So, when you hear that silver inventories are falling, understand that this is not a trivial statistic buried in a weekly report. It is a pressure gauge. It tells us that beneath the calm tone of official statements and the steady climb of equity indices, the physical foundations of one of the world's most strategically important metals are tightening. And when a market shifts from abundance to scarcity, the adjustment rarely unfolds in a smooth, predictable line. It tends to happen suddenly, and it tends to surprise the people who assumed that nothing fundamental had changed. What I need you to understand now is that the real story is not the price you see flashing on a screen. It is the metal that can actually be delivered. For years, the silver market has operated on a structure that most people never look at closely. The majority of trading volume does not involve physical bars changing hands. It is futures contracts, options, and paper claims, financial instruments that reference silver but are not silver itself. In normal times, this system works because only a small fraction of participants ever ask for delivery. But when inventories begin to fall, the balance between paper and physical starts to matter in a very real way. Think about this carefully. If a warehouse once held a comfortable buffer of metal and that buffer shrinks year after year, the margin for error disappears. The market can continue functioning smoothly as long as confidence holds, but confidence is a fragile thing in financial history. We saw this in the London gold pool collapse in 1968, when coordinated interventions could no longer maintain price stability because physical demand overwhelmed official supply. We saw echoes of it in 2020 when, disruptions, refining, and transportation created sudden dislocations between futures prices and physical bullion, forcing exchanges and banks to adjust contract specifications in real time just to keep the system moving. Right now, the signals are subtle but unmistakable if you know where to look. Delivery queues lengthen, registered inventories, the metal actually available to satisfy contracts, decline faster than total reported stocks. Lease rates begin to rise, which is the market's way of pricing scarcity in the lending of physical metal. And then you start seeing backwardation appear, not as a one-day anomaly, but as a pattern. That is the market telling you that immediate possession carries a premium over future promises. In commodity markets, that condition is rarely comfortable. It is usually a sign of tightening supply chains or rising urgency among buyers. And you must not underestimate the role of industrial demand in this equation. Silver is embedded in systems that did not exist at scale 20 years ago. Solar panels, electric vehicles, high-efficiency semiconductors, and advanced medical technologies all rely on the unique conductive and reflective properties of this metal. Unlike gold, much of this silver is not stored in vaults, waiting to re-enter the market. It is consumed, dispersed, or locked into products for decades. That means every ounce used is effectively removed from the available pool, and recycling cannot keep pace when demand accelerates quickly. At the same time, mining supply does not respond overnight. Developing a new mine can take a decade or more, and many silver deposits are byproducts of copper, lead, or zinc production, meaning output depends on the economics of entirely different markets. When global growth slows or base metal prices weaken, silver supply can contract even while demand rises. That structural lag is one of the least understood forces in commodity cycles, but it has shaped every major bull market in metals going back to the 1970s. Now, step back and look at the global context. Governments are carrying debt burdens that would have been considered unimaginable a generation ago. Servicing that debt becomes harder when interest rates rise, which creates pressure on policymakers to avoid prolonged periods of tight monetary conditions. At the same time, currency volatility and geopolitical fragmentation are encouraging some countries to diversify reserves and trade settlement mechanisms. In such an environment, the perception of tangible assets changes. Metals are no longer seen only as relics of a past monetary system. They begin to look like anchors in a world of shifting financial arrangements. But here is where the contradiction becomes almost surreal. You turn on financial television and you see optimism. Equity indices remain elevated. Technology stocks dominate headlines, and volatility gauges are not signaling panic. To the casual observer, nothing appears broken. Yet beneath that calm surface, physical inventories continue to decline and delivery strains quietly intensify. This is the same pattern that has preceded many historical inflection points. Stability on the surface, structural pressure underneath. So, when you hear analysts mention falling inventories, do not treat it as just another statistic. What you are witnessing is a gradual tightening of a system that depends on confidence and liquidity. Markets can absorb stress for long periods, sometimes years, but when thresholds are crossed, adjustments tend to happen abruptly. And the reason these moments shock investors is not because the data was hidden, but because the implications were underestimated until it was too late to ignore them. Now, I want you to focus on what happens when a market stops reacting to price and starts reacting to availability. This is the point most investors never experience until they are inside it, and when it arrives, it moves fast. You have to understand that modern commodity markets are built on leverage, on hedging structures, and on the assumption that physical delivery will always be manageable because only a small percentage of contracts ever demand it. That assumption works until it doesn't. Picture the sequence carefully. Inventories fall, but at first nothing dramatic happens. Prices rise, yes, but gradually. Then volatility begins to increase. You start seeing sudden intraday moves that do not correspond to obvious news. Liquidity thins at certain hours. Bid-ask spreads widen. These are early signs that the market is becoming sensitive, almost nervous. It is like watching a bridge under tension. The structure looks stable, but you can hear the strain if you listen closely. Then comes the chain reaction phase. If large participants begin securing physical supply rather than rolling contracts forward, the pressure accelerates. Short positions, which were comfortable when metal was abundant, suddenly face the risk of having to deliver into a tightening pool. This is when short covering can turn orderly price movements into violent surges. We saw a version of this dynamic in the nickel market in 2022, when a combination of leverage and physical constraints forced the London Metal Exchange to halt trading after prices exploded in a matter of hours. Different metal, different circumstances, but the underlying mechanism, the collision between paper positions and physical scarcity, was the same. At the same time, options markets can amplify the move. When prices approach levels with heavy call exposure, market makers hedge by buying futures, which pushes prices higher, forcing more hedging and creating what traders call a gamma squeeze. These feedback loops are not theoretical. They are built into the structure of modern derivatives markets. Under normal conditions, they are manageable, but when supply is tight, they can accelerate price discovery into something closer to price shock. You also begin to see geographical fractures. Premiums in one region diverge sharply from another. Metal flows toward the highest bidder, draining inventories elsewhere. We have seen this repeatedly in history, during the Bretton Woods breakdown, during the Asian financial crisis, and again, during the pandemic disruptions, where price alone did not tell the whole story because logistics, arbitrage constraints, and capital controls distorted the flow of real material. When arbitrage breaks down, markets lose one of their main stabilizing forces. Another factor you need to consider is the gold-silver ratio. This ratio has moved dramatically at key turning points in the past. In periods of financial stress or rapid monetary expansion, silver often begins to outperform gold once the market recognizes that liquidity conditions favor hard assets broadly, not just the primary reserve metal. That shift can happen quietly at first, and then suddenly, as momentum traders and institutional flows begin to align. Ratios compress not because gold is weak, but because silver accelerates faster. And yet, here again, the contradiction remains. Policymakers continue to project stability. Inflation is no longer dominating headlines the way it did a few years ago. Interest rates, while still elevated in historical terms, are no longer rising aggressively. To many observers, this environment appears transitional, but not dangerous. But history shows that markets often fracture during transitions, not during obvious crises. The late stages of the Bretton Woods system, the period before the 2000 commodity supercycle, and the years leading into the 2008 financial crisis, all carried this same deceptive calm. What shocks investors is not just the speed of the move, but the realization that the warning signs were visible all along. Falling inventories, rising lease rates, backwardation, regional price gaps, increasing volatility. Each of these signals alone can be explained away. But when they appear together, they form a pattern. And patterns in financial markets are rarely coincidences. They are the early outlines of structural change. So as you sit here listening to me, I want you to understand that the risk in a tightening silver market is not merely higher prices or lower prices. The real risk is discontinuity, the moment when a market stops moving in small steps and starts moving in leaps. That is the moment when investors who believe they had time to react suddenly realize that time itself has disappeared from the equation. Now, I want you to shift your attention to what comes next, because this is the part most people misunderstand. Markets rarely announce turning points in advance. They leave clues, quiet, technical, almost boring signals that only start to look important in hindsight. If you want to understand where the situation may lead, you have to watch the indicators that professionals watch, the ones that reveal stress before headlines do. The first thing you must follow is the pace of inventory change itself. Not just the total number, but the rate at which registered stocks decline compared with open interest. When obligations rise while deliverable supply falls, the leverage embedded in the system increases silently. This is not theory, it is arithmetic. Every major commodity squeeze in history, from copper in the late 1980s to palladium in the early 2000s, followed this same mathematical imbalance between claims and available material. Then you need to watch the shape of the futures curve. A single day of backwardation can be dismissed as noise, but persistent backwardation is a different signal entirely. It tells you that immediate access to metal is becoming more valuable than the promise of delivery later. That condition tends to emerge only when physical buyers are competing directly with financial participants for the same limited supply. It is the market's way of saying that time itself has become expensive. Another signal that matters is the behavior of lease rates and short-term financing in the bullion market. When institutions are willing to pay more to borrow metal, it reflects urgency. You saw this in gold during periods of stress in the late 1990s, and again during episodes of funding strain in 2008. These rates are rarely discussed outside professional circles, but they are among the clearest early warnings that liquidity in physical form is tightening. You should also pay attention to regional price differences. When Shanghai trades at a persistent premium to Western exchanges, or when premiums in certain physical markets rise despite stable futures prices, it tells you that arbitrage flows are no longer equalizing the system as efficiently as before. In normal conditions, traders close those gaps quickly. When they remain open, it means logistical, regulatory, or supply constraints are interfering with the balancing mechanism that keeps global markets aligned. At the same time, you cannot ignore the broader macroeconomic backdrop. Real interest rates remain one of the most powerful drivers of precious metals over long cycles. Whenever real yields fall or remain suppressed while fiscal deficits expand, monetary systems quietly shift toward conditions that historically favor hard assets. The 1970s provide the clearest parallel when inflation, debt, and policy constraints combined to produce a decade-long repricing of tangible stores of value. But remember, those moves were not linear. They came in waves with violent corrections and equally violent advances. And here is where the possible paths begin to diverge. One scenario is a period of consolidation, where inventories stabilize temporarily and markets digest the recent volatility. In that environment, prices may move sideways, while structural pressures continue to build beneath the surface. Another scenario is a sharp acceleration triggered by a catalyst, perhaps a surge in industrial demand, a disruption in mining supply, or a sudden shift in currency markets that forces a rapid repricing. History shows that when squeezes occur in leveraged commodity markets, they rarely unfold gradually. They tend to compress years of movement into weeks or even days. There is also a third possibility that must be acknowledged. If global liquidity tightens abruptly, if real yields rise sharply, or if economic contraction reduces industrial demand faster than expected, the market could experience a violent correction before any longer-term trend resumes. This has happened before as well. Commodities are never one-directional. They are shaped by cycles of credit, growth, and policy, and those cycles can turn faster than most forecasts anticipate. What matters most is not predicting the exact outcome, but recognizing that the conditions now forming are not ordinary. Falling inventories, structural deficits, rising geopolitical fragmentation, and unprecedented levels of global debt are not isolated data points. They are interconnected pressures within a financial system that has grown more complex and more leveraged than at any time in modern history. So, as you sit here listening to me, understand this clearly. The most important question is not whether the silver market will move, but how it will move when the next shift begins. Markets that operate smoothly for long periods can change character very quickly. And when they do, the people who have been watching the underlying signals, the inventory trends, the funding rates, the curve structure, the regional premiums, are rarely surprised. Everyone else usually is.